In this tutorial, I'll be going through with you Zynga stock. You just type it in Google, click enter, and you can see the name of the stock, Zynga Inc. And you can see the Nasdaq symbol ZNGA, and it's 6.1 US dollars for one stock, and it's a billion market cap, so it's a big size firm. It isn't paying any dividend. Now, this is something I want you to concentrate on, because companies that are paying dividend, that means they're financially very strong, because after paying their loans, liabilities, creditors, costs, they still have extra money. That extra money it pays to shareholders as dividend. So any firm that is not paying dividend, that means that they might not have extra money, they might not be financially strong, or maybe they have extra money but they choose to reinvest in their own firm, so to further expand. So there could be many reasons to it. So this is something very important aspect to find out the reasons. And let's go to Wikipedia. I want to see when was this founded. I can see in 2007, 12 years ago. Then I just want to see what the employees think about this firm. I'll copy this exactly from Google, right? Paste it here, type Indeed reviews, and I can see that there are 85 reviews. It's 3.8 star. Please read through the reviews yourself. Check out the salaries, the jobs they've listed, the question and answers, and I want to see that what reviews they are getting in Glassdoor. That's very important to me as well. So I can see we have 823 reviews, and it's I don't see any. I can't see any actually. I don't know why I can't see any. If I click overview, no, it says it has given reviews, but it says not applicable. I don't know. The stars are not shown. I don't know why it's not shown. So, but you can just see, look through the jobs listed, the salaries they're paying, interview questions, benefits they're giving, and the photos. And let's have a look at Justia patent and see if it has any patents or not. I will just paste it exactly from Google, and I just want to point out, please look at applicant or assignee, because these are people who have full rights of the patents. And I can see a lot of patents in 2013, 12, and then 13, 14, that's 15, 16. So that's brilliant, because what I notice is that they have recent patents as well, so it means that they're still innovating. That's brilliant. 2017, so they have recent patents as well. That's brilliant. And the more the patents a firm has, the more stronger it is, and the more harder it is to beat that firm in the market. That's brilliant. So it means it's a very, very strong firm, and it has recent patents, so it means it's still innovating. That's brilliant. So go to the patents yourself. Now let's see what who the finance executives are. Who the executives are. You can just go to Yahoo Finance, and I'll just paste it exactly from Google. Okay, and just click on ZNGA, Nasdaq symbol. Go to profile, and you can see the sector, the industry, and the employees as well. And the best part is that they have 5 key executives, but all of their salaries have been shown. So they have shown us all the salaries. It's very transparent. That's brilliant. And the more transparency there is, the more trust we're able to build. Let's go to macro trend and see the ratios. Click price ratio, price book ratio, just paste in the symbol ZNGA. And I just want to point out, if the price book ratio is less than 1, that means stock is cheap, it's at discount, it's a sale. If it's less than 1, if it's more than 1, that means stock is expensive. The higher the number goes, the more expensive it will get. So this website sometimes takes time to load, so don't worry about that, but it will make your life quite easy. And let's see. Okay, right now I can see that it's 3.36. This means that if somebody buys in August, they will be paying 3.3 times more money. It's 3.3 times more expensive to buy the stock right now. I can see in June 2019 it's 3.35 times more expensive. So people who bought in June 2019, they paid $6 to buy something that was $1.8 worth. So it's 3.3 times more expensive. Right now it's 3.36 times more expensive. And I can see the cheapest it was in 2015 September when it was 1.11 times more expensive. So people bought for paid 2.28 price, $2.28 to buy something that was $2.06 worth. So let's go to other ratios. I want to see the current ratio in this thing. If the current ratio is less than 1, that means stock is risky because liabilities are more than assets. If current ratio is 1.5 or more than that, that means stock is safe. It has a good margin of safety. Please look for 1.5 or more than that. Let's have a look. Okay, right now I can see that it's 1.99, so it's a lot more than 1.5. That's brilliant. So it means stock is safe right now. So we have data up till June 2019 only. Let's look at the previous trend. So I can see that there's no consistency because it's less than 1. So liabilities are more than assets. If you just see vertically up in March 2019, so it's a dangerous stock. Let's look at the back. Yes, it's more than 1.5. So I can see that since we have data since 2010 December up till I would say 2018 December, uh, recent 8 years, it has been always been above 1.5. So it's a safe stock since 10 years consistently, but just once it's below 1.5, and then again it's back to 1.5, more than 1.5. So once I can forget about that, that's fine, but consistently it has been above 1.5. So it's a safe stock in terms of current ratio, I would say. Let's look at debt equity ratio. Now, debt equity ratio, this tells me if the company is mainly operating on debt or equity. I'm looking for zero point 0.5 or less than that for it to be very safe. Let's have a look. Please look for zero point 0.5 or less than that. I can see that it is less than zero point 0.5. That means it's a safe stock. It has a good margin of safety. It's less than zero point 0.5. Let's look at the previous trend. Has it ever been above zero point 0.5? No, it has never. So we have data since we have data of debt. It took debt in 2012 June for the first time. So since then up till now, consistently, it has been below zero point 0.5, which means that the stock is very safe in terms of debt. That's brilliant. Let's look at return on equity. So in return on equity, I'm looking for 8% or more than that. Okay, I can see that it's a minus return, which is I'm looking for 8% or more than that, and there's no consistency, and